Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, January the 5th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what is in your portfolio, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Got a lot to go over today. Sorry, the week started out a little rough. I got a new computer and my recording software wasn't working properly, wasn't recording the sound and or the video, and therefore it was very difficult for me to tell you guys exactly what was going on with me and my portfolio and how I was managing trades, putting trades on and taking them off. So I've got a lot to go over today. I'm going to try and do a little bit of catch up with that for those of you who are keeping score and keeping track of this. Maybe you even have some of these same positions on, and so I'm going to talk about those for sure. This is also the week that we talked about. We have a lot of economic data in the form of PMI, which is Purchasing Managers Index. Now with Purchasing Managers Index, it's one of the most important data points or economic points that I look at because it shows what these manufacturing and service sector purchasing managers are doing in regards to demand. They see the demand start to pick up, they start purchasing to start building inventory or the raw goods. So it's one of the most important ones because it's forward looking. These guys see the demand immediately and start ramping up production or pulling back. One other caveat with the PMI number is anything over 50 is expansion, anything below 50 is contraction. But all week we've been seeing pretty good data points that is really kind of relating to this. So we got in Europe, we got the retail PMI number came in line with the expectations at 50.4. We also had Great Britain's services PMI, which came in at 56.2, expected 54.8, so a little bit better than expected on that front. We also had the European PPI, which is the producer price index, a gauge of inflation, and came in at 0.3 versus 0.2. So remember earlier on, well actually if you saw earlier on, we saw some more inflationary numbers on our front, and this is a little bit better. We want to see inflation if there is demand. If there's not demand, then we don't really want to see prices start to increase. So on to the rest of the economic numbers. We've got the ADP non-farm payroll change came in at 153,000 hires, expected to be 171,000 hires, a little bit lower than what was expected there. That is usually a precursor to the Friday number that comes out the first Friday of every month, which is our non-farm payroll. It's usually a little bit off from that. The one to really look at is the number that comes out tomorrow, but that's just a little heads up for that one. And then we also got unemployment claims coming in at 235,000, expected to be 262,000, so a little bit lower than expected on that. Then we also, in the United States, got the final services PMI, came in at 53.9, slightly above the expected 53.4. Our ISM, non-manufacturing PMI, which is the one to really look at. The rest of those, like the services PMI and stuff like that, if it's not ISM, which is the Institute for Supply Management, it really doesn't hold as much weight as this ISM PMI number. Came in at 57.2, expected 56.6, so much better than expected there. And then we also got today the natural gas storage drawdown of only 49 billion cubic feet, was expected to be a drawdown of 97 billion cubic feet. We've been seeing a lot of cold throughout the United States, from basically Minnesota, North Dakota, all the way down to Texas and Arizona area. So a lot of even the South has been seeing a little bit more cooler air. Then we also got crude oil inventories came in at a drawdown of 7.1 million barrels, was expected to only be a drawdown of 1.8 million barrels. Now, you would expect, as we're looking at the chart here of crude oil, that crude oil would start to spike on that kind of news. Now, that's why it's important to dig into these numbers, because with this crude oil number, that's just the headline number. You have to look in there and look at what is happening, why that drawdown happened, and what it's looking like is happening. It's not really due to demand, it's due to production, converting that to distillates and gasoline. And what we're seeing in the gasoline inventories was a increase of a build, I should say, 8.3 million barrel build was only expected to be a 1 million barrel build there. So that means they're converting this oil that's in storage into gas and distillates. It's going through the refineries, through that production cycle, and we're seeing a build. So nobody's really using that gas as much as we would expect. We also saw distillates, which goes into the manufacturing side, a build there of 10 million versus the expected build of 800,000. So there's a lot of gas being converted and not being used. So that's driving down the overall price of crude oil because of the builds on the production side. So oil actually reacting the way I would expect, down slightly on the day. I would actually expect it to go down a little bit more than what we're seeing there. Try and move some of these inventories. Then on to gold. Gold having a huge day today, up almost just over $18, going up to test that 50-day moving average. Now that it's above that 9-day moving average, I talked about it all the way down there, that it needs to get above that 9-day moving average for the bulls to come out and really start pushing this higher, to really show that they're winning, and that's what is happening now. The next line in the sand for the bulls to get through is obviously going to be this 50-day moving average. So as soon as we can see this 9-day moving average cross over the top of the 50-day moving average, that's going to make it look even more bullish. So we'll have to watch that very closely. As you can see right here, when 50-day moving average went below the 9-day moving average, the market really started shooting up, and even more so after the both moving average crossed over the 200-day moving average. So that would be the next line in the sand, obviously. So gold cruising higher as we speak. Then on to the bonds. Bonds having a big day, up almost 2 points. We're up 2 points earlier today, just cruising higher. And again, same scenario. I talked about this. When it crosses over that 9-day, that's going to be when the bulls come out in full force. Then onto the Dow Jones Industrial Average. As you can see, the reason why a lot of the gold and bonds are up big is because the Dow Jones is down quite a bit and below that 9-day moving average. So Dow Jones Industrial Average down over 100 points. I talked about this. I think we're going to see a bigger correction before we see a resumption to test that 20,000 mark. There's just too much euphoria out there for that to happen right now. Everybody, the retail sector is getting in there, and that's probably the time to be getting out. NASDAQ bunking the trend, I should say, up almost 12 points on the day. Again, testing this value area high, which is going to act as resistance. We're going to have to see if we can get above that and settle, but the way the Dow Jones is acting, I think it's going to pull down the broader market for the most part. As E-mini S&Ps following suit with like the Dow down on the day, NASDAQ really the only one up on the day. I think even the Russell's down on the day. The E-mini S&Ps down just over 8 points right now. This is the overall outlook on the E-mini S&Ps. Really the economic data points that we saw on the PMI numbers and ISM, those numbers would expect us to push higher. It did help, but once we got those crude oil inventories, that's when the overall market got a little bit scared, because it shows that there wasn't a lot of gasoline, probably not a lot of driving for the holiday season, which isn't really great for the economy. That's when we're going to want to see a lot of people moving around and about. Now, I know I'm going a little bit long today, but we got a lot to go over. These are the trades that I've done. This was the trade that I did on the 2nd. It's Altera ticker symbol MO, and I had on the January 64.71 strangle, if you remember, and I originally sold it for 75 cents. I bought it back for 50% of my net profit right there at 38 cents. So following in line with my rules. So you probably could even get out of it a little bit better as time has passed, and we've seen even volatility contract since I took that off. So if you have that trade on, take a look at it, because you are likely over 50% of your max profit potential. So that's the time when I follow my rules and cover those trades. With GPS, this is a trade that I actually put on, and I did this on the 3rd, did the February 23 straddle, and I collected $2.93 for that. Now, you can probably do this a little bit better. I sold that straddle because it had high implied volatility. The binary event happens after my options expire, but as we can see, volatility is really kind of expanded, and it really hasn't it spiked yesterday, but today it's right back in line where I sold that. I actually may sell just a little bit more of that straddle because we're right back in there, and I've got a little bit higher implied volatility, so I probably can get a little bit better price for that. So then on to Lululemon. Lululemon, if you guys remember, I did this on the 3rd as well. I had on a strangle for an earnings event, went through my short 65 calls. I took possession of those, so I was short Lululemon at 65. Immediately went in there and sold the 65 puts. It actually went my direction, and I waited a little bit too long. And then on the 3rd, when we saw this spike, I was hoping to, if it confirmed to the downside, I was going to stay in that trade, but it spiked to the upside, and as soon as it started doing that, I got out. Not at a very good price. I waited a little bit too long, rallied really hard right out of the gates in the morning, and then came back off. That's when I decided, you know what, I'm getting out of this and pulling the trigger. I decided just to cover my shorts in this stock, and I was short the Lululemon at 65. I ended up buying them back at 66.38. So I lost about $1.38 on that trade, but because I sold those puts originally immediately, I sold those 65 puts for $1.67. So I'm going to kind of ride those out into the sunset and try and get my full premium for that. So that would be a scratch for that trade. Don't normally leg out of those, wasn't planning to leg out of that, but the way that the market really started reacting, it just seemed like there was some whisper news, rumors, or whatever that was not going to benefit me. So I decided to leg out of that, and hopefully it will work out. But don't usually recommend doing that, but it was just a shooting from the hip kind of situation. Then with Bristol Myers, ticker symbol BMY, I had on the January 55 puts. I also did these on the 3rd. Originally sold them for 56 cents, bought them back for 26 cents. So it was a nice trade there. Then on to Hertz, which I did yesterday. And with Hertz, basically got everything working my way. The market actually spiked a little bit yesterday and was able to get out. The premiums weren't really decaying very fast in that, and markets actually were getting a little bit wide in there. So I'd been working this throughout the week to try and get out, but on yesterday, the market appeased me, rallied up, and was able to get out for better than 50% of my net profit, or max profit, I should say. And I had on the January 20 puts, originally sold them for 55 cents, was able to buy them back for 15 cents yesterday. So you can probably get that today. Just put that in there. Those markets are a little bit wide. Put it in as a bid and let it rest. So somebody will come in there and pick you off, happily so. Anyway, then UAL is a trade that I'm actually trying to get out of right now. The problem with this one, it's gone my way perfectly. I have on the January 80 puts that I bought, and then I sold the 70 puts to help finance some of that extrinsic value on that, just in line with the rules that I set up. This was actually a setup for that put spread webinar, and was able to get back 50% of my max profit on that. I originally paid something around 55 or just over $5. So I'm looking to try and get out of this at around $7.50. The other one that I'm also looking to get out of is my NVIDIA, which is ticker symbol NVDA. And with that one, let's see if I can get this to load rather fast. Trying to get out of this one. I also have on the January 120 93 strangle and trying to get out of that for right around 50% of my net max profit, I should say. Originally sold that for about $2.20, trying to get out for about $1.10 right now. It's not really working out, but it's pretty close. It's about 20 cents away, I think, 20 to 30 cents away. So just put it in a resting order. Hopefully I'll get hit on both of those sometime today and be able to talk about that tomorrow for you. Sorry this went a little bit long, but like I said, we had a lot to go over with all the economic data that we've missed, a lot of things going on, and missed out on talking to you guys about a lot of those trades. So tomorrow we're going to be doing a webinar on the collar, which is something that a couple of you guys were talking about in the last webinar, where we were doing covered calls, and this is also a way to protect yourself to the downside. When one of my followers was talking about how she lost a lot of money to the downside, wanted to be able to protect that. I talked about doing the poor man's covered call, which gives you synthetic protection to the downside. There's a synthetic put in there, but a lot of people have these stocks in their portfolios, and this is going to be a way to wrap around protection to the downside with a covered call. So it's a way to pay for a stop in a sense, right? So go to protraderstrategies.com, sign up for that. That's all I got for you guys today, and I hope you guys all had great holidays. And if you can't take that, take it easy.